Imagine receiving a wonderful gift or inheritance from a loved one overseas, a true blessing. While this can be a joyous occasion for those residing in the United States, there's a crucial step that often gets overlooked, and missing it can lead to significant headaches. Yes, there absolutely are penalties for not reporting foreign inheritances to the Internal Revenue Service. The United States tax system has strict requirements for disclosing foreign financial assets and transactions, and an inheritance received from a non-U.S. person or estate falls under these reporting obligations. The primary reason for these penalties stems from the Internal Revenue Service's commitment to ensuring tax transparency and preventing tax evasion, especially involving foreign assets. It primarily relates to what's known as Form 3520, an annual return to report transactions with foreign trusts and receipt of certain foreign gifts. This form is an information return, meaning you are reporting the receipt of the inheritance, not necessarily paying a direct tax on the inheritance itself. The penalties for failing to file this form or filing it late can be substantial, often starting at 5% of the amount of the foreign gift or bequest for each month the failure continues, up to a maximum of 25%. To avoid these costly penalties, the key is proactive reporting. Once you receive a foreign inheritance, or even a large foreign gift, you need to determine if the value exceeds specific thresholds. For example, if you receive more than $100,000 from a non-resident alien individual or foreign estate, you generally must report it on Form 3520. Gathering all relevant documentation, including details about the giver and the amount or assets received, is essential. Working with a qualified tax professional who understands international tax reporting is highly recommended to ensure accurate and timely compliance. It is important to remember that these are reporting requirements, not necessarily income tax on the inheritance itself. The United States generally does not impose an income tax on beneficiaries for inheritances they receive. However, failing to file the required information return, such as Form 3520, can trigger severe penalties. These strict rules are part of broader efforts to track wealth crossing borders, including provisions like the Foreign Account Tax Compliance Act, or FATCA, which mandates financial institutions worldwide to report information on U.S. persons to the Internal Revenue Service. Navigating foreign inheritance rules can seem complex, but understanding the reporting obligations is vital. By accurately and promptly reporting foreign inheritances to the Internal Revenue Service, you can effectively avoid substantial financial penalties, safeguard your financial well-being, and maintain peace of mind, allowing you to fully appreciate your inheritance without future worries.